Thanks, Jackie.
Welcome.
Great to be here.
Hi, everybody, and welcome to all of our attendees. Please feel free to start popping your questions into the box for Leor. But before we get started on that, we're going to just hear a little bit from Leor about the investment opportunity. Leor, before we get started, perhaps we can just briefly look at how many 12J investment opportunities there are in South Africa. Is this a very big space?
Interesting question. So, a little bit on the history on 12J is that originally the section of the Act, the Income Tax Act, that 12J section, was originally introduced in 2009, and very little happened between 2009 and 2015 until they made a few amendments. And then from 2015, 2016, it became very active, and many different 12J funds opened. And interesting enough, now it's a sunset industry, because the 12J, the last opportunity to get a 12J investment ends at the end of June this year. So it was a 12, when it was introduced, it was always going to be a 12-year period. The industry asked government to extend that period, which they declined to do. And so now there are many 12J funds, many registered, active, probably probably around 50, I would say, that are active, but much more than that are registered, that never ever maybe made investments.
Oh, that's very interesting. So there are quite a few that are registered and have actually not gone on to invest. Did those ones that were registered, did they actually attract funding? Do you know?
I don't know the details. Some maybe very little funding or no funding at all. I suppose people saw the opportunity. This is interesting, be able to, using a tax benefit to enhance investment returns, and as a result, registered a fund. But, raising money is a different story as opposed to just, as a business model. So, yeah, many that never ever actually made investments.
Yours has made it, and you've got very high-profile investors involved, like Gideon Novik, the entrepreneur behind Kalula, who's put his own money into this fund, we heard. So, Leor, perhaps before we take, and I see the questions are coming in thick and fast here, Leor, perhaps you could just briefly take us through the Lucid 12 Retirement Living Fund opportunity.
Okay. Are you going to play the slides, or should I just talk to...
I'm going to, sorry, let me put the slides on. There we go. Can you see the slides?
Yeah, great. So
brilliant.
Perfect. So let's go to the second slide. So that's a little bit about the history of Lucid. And you mentioned that, we did make it. We've actually got this. This is the third Lucid fund that we're raising money for. So the history was, as I mentioned, 2015, 2016, Lucid was the first fund that was formed. Was actually the first fundraise was in February 2016, and the mandate at that point was Lucid was going to do venture investments, and different private equity investments or venture capital investments in a number of different funds in different companies. And that started for a few months, even up to about a year. But very quickly, what was apparent is investors were more very concerned about the risk and the risk involved with venture capital investing. Very easy to lose all your money. If you make an investment into a company which fails, potentially all the money is lost. And notwithstanding that you get a tax benefit, if you lose all your money, you lose all your money. Your after-tax money, fair enough, but it all gets lost. So the business pivoted, that Lucid Ventures pivoted and moved into looking at hospitality. So just to understand around 12J, the 12J fund prohibits the fund from making investments into property per se. So the reason that the opportunity came about, the reason that government introduced this 12J into the Act was to promote venture capital investing. And from their side, property wasn't venture capital, so they didn't want investments to go into property. They wanted them to go into more risky investments. But of course, looking at investors wanted less risky investments, and property is certainly less risky than some normal venture capital. So what Lucid did, there was an opportunity to invest in hotels, and the beauty of a hotel is, while it was considered a venture capital by the 12J legislation, it has a property underpin. You actually are investing in property. So that's where Lucid Ventures moved to, and initially started investing into hotels or units in hotels run by other operators, and that was like the Radisson in Cape Town. We've got a few units there, the Onyx in Cape Town, something called the Regency in Pretoria, and just buying up units run by other hotel operators. And that was a fairly successful strategy, and obviously the risk mitigated by the fact that you've got property as an underpin. That continued, and a second Lucid fund was formed. That was 2 years later, called the Lucid Hotel Fund, also very much in that space. And then a year later, we decided to look at our own hotel brand. Instead of investing in other hotel operators, to launch our own hotel our own hotel brand. And then the Home Suite Hotel brand was launched. And we have the Bristol, which is our flagship, the Bristol Hotel, which is operational in Rosebank in Johannesburg. We've got one in the Waterkant in Cape Town, and another one opening up in Sea Point in the next few months. So that's a bit of a move, still in the hotel space and still doing hotel investment, but now as a hotel operator, not just owning the hotel itself. And I suppose we went along our merry way until COVID hit. Obviously 2019, 2020, COVID hit, and that's clearly had a massive impact, everybody will know, on the hospitality industry, on hotels, and we were certainly impacted. Our hotels that were operational lost a lot of clientele. We changed the business model there, where we did a lot of long stay investments as opposed to the short stay investments. You get to at least tie in customers or residents, but obviously at a much lower daily rate. And that we did. And then when it came to fundraise for our 2021 fundraise, this was in February this year, very difficult to raise money in a COVID environment for a hotel investment. And that's where, interesting enough, we looked at the retirement space. And that's what this fund is about. It's looking at retirement, which is still falls under the hotel fund. So it's still basically considered, from a 12J perspective, still considered a hotel investment. It's compliant with 12J as a result, because to be a hotel, you have to provide board and lodging, and you have to provide food as one of the offerings, and that's all that's offered within the retirement space, which means that this is a great opportunity. Because interesting enough, separately, some of our partners were looking at the retirement space even without a 12J hat. And the fact that we can marry a 12J investment with all its tax benefits with a retirement investment, which is attractive in its own right, which I'll talk to now, is really best of both worlds. Let's go to the next slide.
Why retirement?
Why retirement? Right. So, I've explained why not hotels for the moment, and not that, I mean, we do believe that hotels will come back over some period when we get out of the pandemic, but why retirement? And certainly a growing sector in the market. Human longevity is growing. Forecasts that are currently in South Africa, 5 million people over the age of 80 in 2020, and that will grow to almost 9 million by 2040. So a large growth sector, just with human longevity, and a very underserviced market. So if you look at a typical retirement home, and there are obviously different retirement homes which service different sectors of the market, we're going for certainly the high end of the market, and the facilities we intend to build are the high end of the market that we're targeting. But it's an underserviced area. You've got a very, very long wait list. Anecdotally, my parents, a year moved into a retirement home, they waited, I think, about 2.5 years before they got into that facility. And that's almost, in terms of the sector of the market, across the board, very long waiting to get into the facility. So it's an underserviced market, and we believe there's a place we can disrupt it a little bit, use some different ideas, but it's a nice growing sector. So it's not to say that we're going to try to take out competitors. We believe we can ably compete with the existing players in the market. Our model is an age-in-place market. So currently, what's kind of standard, now it starts getting quite technical in terms of retirement, but to keep it quite simple, normally in a retirement facility, you've got 3 different types of residents. One will be completely independent, then you'll get assisted living, and then you'll get frail care. As people age and need more assistance, they move through those different cycles. And what's very common in a normal facility is, as you move from one to another, as you move from independent to assisted living, you'll move into a new place where assisted living is given. And when you go to frail care, you'll move into another facility where frail care is offered. Our model is to build, it's what's called age in place, very quite normal in an international context, but age in place, you buy your apartment, the care is brought to you. So whether you are independently living, or you're on assisted living, or you're on frail care, in either context, you stay in that place, you age in your own apartment, and you don't move once you're living in the retirement facility. And then I suppose what's common with most industries is that with the advent of technology, there's opportunities to use technology to enhance the service offering and to use it in clever ways, monitor the residents, just clever, certainly things about wearables and technology to enable them to communicate with loved ones, to provide feedback to family members on an activity of them. There's a whole host of different things that where one can use technology to enhance the offering. And sometimes, even though we're a new player in this space, sometimes it's a competitive advantage to come in without legacy systems and building facilities with the new technology and new ideas in place and not have to deal with legacy systems. So let's go to the next slide.
Risk.
So, yes, managing the risk. And, obviously I introduced it around, took a little bit of the history of 12J and of Lucid in terms of people wanting to manage risk and obviously don't lose money. If you follow Warren Buffett and Charlie Munger, or the Berkshire, like the rule number one is don't lose money. So how do you try not lose money is you obviously try and manage your risk. And while the hotel space is so interesting, and certainly the retirement space is so interesting, is that you've got a real estate underpin, in that we are basically, the money that investors are putting into the fund is going into actually bricks and mortar. We are buying land, we are building facilities, which always have an inherent underpin. So one could never lose all the money. There's always going to be an inherent value to what we're building. So that's the real estate underpin. Certainly, when it comes to a thing like this, you want to make sure that you're investing in an experienced team. I've got a slide on the team, and I'll come back to that. But just suffice it to say is that there are a number of different skill sets and a number of different requirements that one has to pull something like this off. You've got financial requirements, you've got asset management requirements, you've certainly got managing retirement homes requirements, and those type of skill sets, which are very diverse. And we've pulled together a diverse set of skills from different teams that are going to be managing this investment. Other ways to manage risk is via pre-sales. So before one, we've certainly got some good, as we've done some market research around, as I mentioned, but lots and lots of interest in terms of the homes that we're going to be building. And before one pulls the trigger and actually starts building, that starts developing, we'll certainly do some pre-sales to make sure, because that ultimately will become your biggest risk. As long as your builders know what they're doing, they build a good facility, you just want to make sure that you can actually sell all the units. So we'll test that. You're never going to be able to sell all the units, but before we start, we'll test the market and make sure that we will be able to sell the units, or a portion of the units, before we actually start building. The finance structure is important as well in terms of managing risk, and that's certainly what Lucid, a big part of what Lucid does. The 12J itself certainly enhances return because of the tax deductibility for investors. But even the whole structure that we've put in place around, maybe I'll talk to it, and I'm sure it will come up in some of the questions, but our model is very much, we're going to focus on life rights, and now I won't talk too much about that. I'm sure that will also come up within the question. It's going to be a life rights model, and it's going to be a property company which owns the property, but then a life rights company where you actually sell life rights to residents. But the financial structure itself is fundamental in terms of enhancing returns. And and in addition, we'll be getting some external finance. So sometimes you could see this as a risk, and sometimes you could see it as a risk mitigator. So on the risk side, certainly the banks are going to stand ahead of investors when it comes to their money. The banks, we will approach the banks to fund part of the cost of the development, because it's going to be, these investments are going to be costly and expensive. And the upside of that is investors can gain comfort from the fact that the banks, like large financial institutions, will be doing detailed due diligences on our investments, on the properties, and on our business model. So if they're going to be comfortable to give capital, it will give an investor a sense of comfort that they don't have, investors themselves haven't got the ability, the time, maybe the return to do such a complex due diligence. But one could rely on the fact that the financial institutions will be doing that. That's just a bit on the finance structure.
That's very good. Good point. And then exit. So when it comes time to get a return out of your 12J investment.
Correct. So, hopefully people should know that a 12J investment basically has a 5-year time horizon. So it's a minimum of 5 years that you're investing your money for. And what that means is that after 5 years, many of the investors will want their money back. Great, I got my tax benefit up front, but now after 5 years, where does the cash come from? And to be honest, when we raised the hotel fund, the anticipation was that we'd potentially be able to sell the hotels or raise debt funding into the hotels at that point. And that with COVID now, that hasn't transpired. So the liquidity of the hotel fund, the previous fund, is much more difficult than the retirement fund. And that is because the retirement fund generates liquidity immediately. So what happens in terms of the cash flows, we raise cash, investors put money into the fund, we then build the facilities, takes two years, say on average, to build the facility, and immediately we sell the life rights. And the life rights, what the life right is gives the residents the right to live in their unit for the balance of their life. So there's an underlying liability to the life rights company which has sold it, but that liability is to be able to provide a living facility to that resident over the duration of their life. They continue to pay levies for a normal levy on a monthly basis, but they themselves own the life right, the right to live in their property. What's important is with the cash for that life right comes back into the life rights company, and that can then be used within a 5-year period to repay the banks and to repay the investors. So there is inherent liquidity in the model. One doesn't have to say, well, how are you going to sell, where does the cash come from? The cash comes from the life rights. And we can potentially talk a little bit more about the business model and how the company makes money in terms of the growth of the life rights, but that gives investors a sense of comfort that there will be cash to repay them. The other option, the other thing we have done on the one side to create liquidity, but the other side also to like an additional value add, is give investors the right to convert their shares to buy a unit. So basically, if an investor is interested, once they invest some money, they can go into the waiting list to say, well, I actually want to want to buy a unit in one of these retirement facilities. And then, of course, it's the unit gets valued, the life right of that unit gets valued at the time, the shares get valued at the time, and there's either an additional cash payment or a cash payment out. But it's a nice value add that an investor for themselves or for a family member can use their investment to buy a particular unit in one of the facilities. Let's go to the next slide.
And this is where your team is particularly strong when you look at the environment of 12J. You've got, really big names behind this investment opportunity.
Right. So, yeah, Lucid, as I mentioned, we've been doing this for now 5-6 years. The Lucid team itself, so there's myself, there's a number of people. It's just got three people on there, but a number, obviously, people behind the Lucid name. But there's myself, there's Gideon Novik, who is well known in terms of his Kalula and Discovery days, and then Leonard Fine, also many years of investing behind him, good corporate governance, and a fantastic, I would say grey hair, but as you can see from the picture, no hair. But yeah, so that's the Lucid team. On our development side, our builders, Cummings and Staples, would probably be well known to many people in terms of building properties, hotels. They actually built the Bristol Hotel that I mentioned earlier in Johannesburg. They built that, but very accomplished builders. And in Johannesburg, that's Andrew Cummings, John Staples as our building partners, and then our architect Julian Katz, who stands independently in Julian Katz Architects, but very well respected architect in Johannesburg. And then very importantly is our partners in the retirement space, and obviously that people who understand how to run retirement homes, and that's the Korean Briett and Michael C from Silveridge. And they could be well known to this audience. They actually ran, Michael was the CEO and Korean was the COO of the Chevra Kadisha, which is the Jewish organization which runs many old age homes in Johannesburg, and very, excess of 200 million rand budget on an annual basis, very large facilities. So both Korean and Michael, many years experience in terms of running facilities like this.
Before we move on, can you just give us a bit of your background as well?
My background, sure. So I'm an accountant by training. My background is first I did articles at what was then Fisher Hoffman Stride, and then went into two of my closest friends had started a business, tiny little business at that point called Internet Solutions, and I joined Internet Solution basically straight out of articles, and worked at Internet Solution that was bought by Dimension Data, but worked within the Dimension Data, first at Internet Solutions as financial director for 4 years, and then within a venture capital business within Dimension Data called Protocol for 3 years. And so even though I'm a finance person by training, I've always been in the technology space. And post that, then started to get onto my own entrepreneurial dream, and started some businesses in the telecommunications space called the SciComm Group. And there were numerous different companies, and still are numerous different companies in the SciComm Group, doing voice over IP and doing a whole host of different things in telecommunications, international voice termination, and that lasted for about, still it's ongoing, but I'm now non-executive in that business ever since I moved to Cape Town 3.5 years ago. So now I've become non-executive, and now I just do I do private equity investing in businesses that interest me, and my passions are education. I've got a couple of investments in the education space, certainly telecommunication and the hospitality space. But most of my time at this point is focused on Lucid. It's very time. None of the other roles are executive. I'm non-executive in all those other roles, so I do have the time to spend on Lucid and structuring this fund.
Thank you, Leor. We'll come back to, just for the attendees, please start getting your questions coming through. I see that there are some questions that have been asked already. Before we start on those questions, Leor, can you just briefly sketch out the minimum investment amounts here? And right, is there a maximum?
So unfortunately, there's a maximum, and that's government legislated, and that there's no maximum amount that one can invest in the fund, but there's a maximum tax deduction. And the tax deduction, this is something new which was introduced by SARS 2 years ago, to say that the maximum tax deduction one can get is 2.5 million rand for an individual and 5 million rand for a company. So that's if one had to put a larger investment than that, you'd only get a tax certificate for the amount for 2.5 million for an individual, 5 million for a company. The minimum is set at 1 million rand. There are ways to invest less, but that would be by application, where potentially lump you with somebody else, etc. But ultimately, typically, as an individual investor, we have taken investments from 1 to 2.5 million. And
thank you. Well, our first.
Should I talk to the fees? The fees on the slide. So, as in line with how do we make money as the fund manager, we charge a 2% annual fee on the assets under management, and then there's a carry of 20% of the full capital, not the pre-tax number. So if one invests £1 million, notwithstanding the fact that you'd get a 450,000 rand if you're on the marginal tax rate, tax deduction in the year that you make that investment, only once we've returned the full £1 million to you, which then in itself represents a 450,000 rand increase in your investment, only at that point do we then take a 20% carry on anything additional. So in that example, if we had to return 1.1 million to you, we would take an additional 20% of the additional 100,000 over 1 million rand.
So that's kind of like a performance bonus.
That's a performance bonus, yeah, exactly. To make sure we need to be aligned with investors, and we absolutely are. The idea is to grow the value of their investment.
And just speaking of alignment with investors, I interviewed Gideon Novik last week about the 12J investment opportunity, and he's put some of his own money in. Is your money also in this fund?
I do. Yes, I do. I mean, there's been fundraising. Obviously, every year since 2016, there's been fundraising. So I, every year, have put money into the different funds. At February now, I put money into this fund, and I again will be putting money into in June. So I obviously wear two hats: one as an investor, but two obviously as the fund manager. But I absolutely, between all those people that are on that slide, if it was Andrew and Julian and Gideon myself, we all invested into the numerous funds, so completely aligned with our investors and putting our money.
Is that because you have to, or is that because you want to?
No, that's want to. There's no requirement for us to do that.
Thank you. So Charles has the first question, and he wants to know: will the finalizing of my estate be delayed if I die before the 5-year lock-in ends?
So the finalizing,
in other words,
I get the question. Yeah, the way SARS currently works is that if one does die in the period that if you make the investment now and you die within a 5-year period, And maybe that's even worth, just as a general thing, what happens if you do sell your investment before, then you get a recoupment. It's not like illegal to do it, but you will get a recoupment. So the tax benefit that you got up front, you would lose. So let's say you got that, you save 450,000 Rand tax when you make your investment, but then you go and you sell your investment within 3 years, before 5 years is up, you'll then get a recoupment. And in that year, you would be taxed on that money. That's, as it currently stands, that's what actually would happen with a death. In the event that that could be pushed out, then to the 5-year period, and I think this is what Charles is asking. If you had to then push it out, I mean, on the one side you wouldn't push anything out, but then there'd be a tax consequence and there would be a recoupment. In the event that it got pushed out, then yeah, if you wanted to try avoid that, and the estate was only finalised after the 5-year period, then there wouldn't be a tax recoupment.
Thank you. Jason wants to know, what entity will you invest in, and do you get normal shares or preference shares?
No, they're normal. Then it's a PTY. I assume that's the question. It's a Lucid retirement fund. It's a PTY. You get normal shares. All the shares rank pari passu with one another.
And we've got an emailed question in here from Rohan. He wants to know, can you offset capital gains tax against the 12J? So can a 12J investment offset a CGT liability in the year made? This is a specific question.
Okay, so what I think he's saying is, like in the current year, he's made a capital gain. Can he now invest in the 12J to offset that liability? So just capital, just if one understands how income tax works, capital gains form part of your income, but only as an individual, only 40% of your capital gain is included in your taxable income. So what happens is, let's say I make R1 million capital gain, 400,000 Rand of that will be taxed at normal tax rates for income tax purposes. So that's why people will talk about the effective tax rate for capital gains is actually 18%. On the marginal tax rate of 45%, 40% of 45% is 18. So the short answer to Rohan's question is yes, you can absolutely, you've made a capital gain of R1 million, 400,000 of that is taxable. If you had to invest 400,000 into the 12J, you would offset that tax liability on that 400,000 with that 12J investment, and you wouldn't pay any tax. So it's not to the full million, it would only be 40% of the million. For a company, 80% of your capital gain is taxed, obviously at a lower rate of 28%, but the same model would apply. Companies could offset that liability that they would have for capital gains tax purposes by investing in a 12J.
Thank you. Maude wants to know, can she skip the queue if she invests in the 12J for the actual retirement living?
Yes, well, she goes to the front. Absolutely, our investors go to the front of the queue. I mean, we still have to build the facilities, and we do intend to buy as well. Just to, there are two within our pipeline. There are 2 actual facilities that we're looking to purchase as part of this our rollout of retirement homes. But that's exactly the intention, that should go. Investors will go to the front of the queue, and as soon as the facilities are available, we'll be able to offer them one try. Well, they'll be front of the queue.
And will that money go as a deposit towards acquiring a life right? Can you just elaborate on how the financing works if they want to go for this investment because of the retirement lifestyle?
Right. So the tax and the cash flow is quite complex, because we don't, obviously, the last thing we want to do is create a recoupment event for our investors. So a lot will depend on timing, and the clever ways we'll certainly structure the tax to make sure that investors don't incur recoupment. But let's assume it is after 5 years. So the investor makes the investment now, and the investments, let's say they invest 2 million Rand today, and after 5 years they decide, right, I'm not going to get my cash out. I want to convert that into a life right. The life right will be valued after 5 years. They'll convert, their shares will be swapped out for a life right. Let's assume the life rights are worth 2.5 million. They would have to invest an additional 500,000. If the life rights are worth 1.5 million, then we would give them the life right plus 500,000 Rand of cash. So it's just that type of mechanism. The tax consequences, if the life rights one wants to invest into life right early, are complex, but we will, we'll work with the investor to find a way to manage that.
Thank you. Leor, quite a few questions coming in here along the lines of this. Must the investment be in cash, or will there be a finance option where the bank will fund the investment or can the shares be pledged to a bank as security? So perhaps you could just talk us through whether you've got any special financing arrangements or whether individuals must sort this out for themselves.
Right. We did approach some financial institution in terms of like financing side. Banks for themselves, for the most part, are not. They don't want to fund 12J for their own reasons. You know, it's a tax benefit, and so this year is actually quite unique because all other years that we've done capital raises, they've been done at February, and for the most part, investors are actually saving their tax as at that date. In the current year, the cutoff is June, which means that investors may be out of pocket and may themselves not have the money. So there are two options. One, investors could certainly approach their own financial institution, pledge their shares, and give the cash be invested with us, and in that manner, that they almost sort that out for themselves. So that's almost dodging the question in some way. Like that's your problem. From a 12J perspective, as a fund, in order for us to give the certificate, the investment needs to be made before the end of February. Before the end of June 2021. But the actual certificate's only actually issued in February 2022, at the end of the taxpayer's tax year. So there's an opportunity to provide some financing. And it's actually not going to be financing. Our intention there is we're going to ask investors to place a minimum of a 25% of the investment. So if they want to invest R1 million as an example, they would invest at least 250,000 in cash. The balance of the 750,000 Rand will need to be invested before the end of February, and then we'll be able to issue them the certificate. But they would be pledging that they intend to take the full $1 million. It's just a delayed payment of the balance of the 750. Just to reiterate, how we're going to do that is we'll actually charge a slight premium on those shares. We can't charge interest, because if we charge interest, then we get into the realms of credit. Now we become a credit provider, and that we haven't got that license, and there's complexity about doing that. But how we'll get around that, or how we'll manage that, is we'll charge people who invest up front. We'll get a slightly lower cost per share if you pay before the end of June. But if you're going to pay 75% or a percentage at the end of February, you'll pay slightly more per share. And in that manner, we'll be able to give you 8 months worth of funding or finance equivalent, but not beyond that. Thereafter, you would have to have invested the money before the end of February.
Thank you. Austin has a question. Does Immigrating create a recoupment event, or can the investment still run to the 5-year maturity? Quite a good question, given the number of people who are contemplating immigrating.
Or, sure. Yes. You know, I suppose, like, even within immigration, and I'm no tax expert on this, so I would say you've got to get some tax advice on this specific question, because even when you immigrate, you financially immigrate or not, there's different ways that one immigrates in terms of your tax status as an individual. So to the extent that you're still a South African taxpayer, you shouldn't. I would assume that one wouldn't create a recoupment. But if you're no longer a South African taxpayer, that potentially could trigger recoupment. But I'm going to just say I'm really not sure, and that's something you're going to have to get financial advice on.
Okay, then Jacques has a comment. I assume I will only get the tax rebate back when I hand in my 2022 tax assessment. The South African Revenue Service is very slow with paying back tax credits. Is there a different way to getting the tax rebate earlier, for example, deducting the R1 million from my salary, say over 9 months?
So to answer the first part of the question, that is correct, unless you're a provisional taxpayer, right? So if you're a provisional taxpayer and you make your, I just lost you, Jackie. Can you still hear me?
Yeah, I can still hear you. Yes.
Sorry, your picture went. Okay. In terms of a provisional taxpayer, if one makes your first provisional taxpayer for a normal taxpayer at the end of August and the second provisional taxpayer at the end of February, then as a provisional taxpayer, you are more than entitled to reduce based on your estimated taxable income that you're going to have for the 2022 year. You would pay a lower amount of provisional tax at either the end of August or the end of February, and in that way, you'd get the tax benefit earlier. So that if you're a provisional tax, if you're not, and it's PAYE, and then you have to actually claim back your tax, then that's the way it's done. It's obviously you put your tax return in. As I mentioned, for the last 5-6 years, I've claimed back. I wasn't a provisional taxpayer, so I've always had to claim back from SARS, and sometimes quicker, sometimes slower, but generally within 1 to 2 months. Often that like sometimes they did an audit, they wanted to see the actual VCC certificate, but normally within 1 to 2 months of the tax return being submitted, I got the tax back. In terms of reducing salary to do it, like it gets complicated because now you're paying less PAYE, but you're still going to do that. Have to think through that, but I'm not sure that's necessarily going to work.
Thank you, Leor. Lots of interest in this 12J because of the lifestyle aspect. Jason has a question. What would a typical life right cost for a standard unit for, say, a 75-year-old male?
Yeah.
Or female? Question. Are there different prices for men and women?
Definitely no difference. So let me talk a little bit about a life right and what a life right means. So as I mentioned, it's kind of equivalent to buying a unit actually owning a unit. Why life rights are so popular is that in your later years, owning a property from a tax perspective, not great, transfer duties, etc. Then it goes into an estate with additional transfers when you do pass away. So life rights was a model that was developed because it gets around that. You don't actually have to own. And in addition, in terms of maintaining a property, when late in your life, you probably don't want the hassle and the complexity of, you own a property and things go wrong and you've got to fix different things. So you almost outsource that entirely to the property owner. So in a life right model, the property owner keeps ownership of the property, and yet the life right owner has the right to live in that property for the balance of their life. Typically, when one looks in the market, the price for a life right versus the price for a property are quite similar. You need to appreciate, of course, that when one buys a life right, one only buys you buy the life right in your unit, but the unit is in a retirement complex with a whole host of different facilities and additional call it shared facilities which enhance the experience for the resident. So that obviously comes at some type of a cost. Whereas if you just bought an apartment in a residential accommodation, you just got the apartment. There might be a lobby, but that's typically what you would have. This is different. There'd be like entertainment rooms and cinemas and gyms and all those kind of added things which would be of interest to a retiree, and in addition, obviously, access to specific types of care that are typical of the retirement age people. So, and the way it's built, and obviously the apartments themselves are going to be very built specifically with that in mind and make it very retiree friendly, if I could use that term. So. In terms of the cost, obviously depends on the apartments. I can talk around the one that's been targeted now for our first one that we're building, which will be in Rosebank in Tottenham Avenue, and those units there would probably, life rights will cost approximately 2.3 million rand. That's the intention. I mean, it's early on. We haven't yet obviously started the construction, but based on the planning and the architecture, etc., approximately 2.3 million.
And Leor, just with your tech background, this question dovetails neatly to the whole aspect of what are you doing that's different from other retirement homes? Tell us more about your tech. Do you, for example, have tech that's wired up to doctors that can keep tabs on people's pacemakers?
I'm not the expert.
Not yet.
Well, I mean, I can talk about, obviously we've discussed it in some of the key tech stuff. So certainly a wearable device is a key item, right? So in terms of tracking how the resident themselves, how active they have been. It's important that they're not sitting, a resident is not sitting alone in their room and not actually moving. So that one takes that data in terms of the activity of the resident and sends that to the loved one or themselves in terms of encouraging to get out and be more active around. Then something obviously I mentioned in terms of specific technology to enable them to communicate in an easy manner with their family or potentially overseas or wherever they are, but providing for. But there's a whole host of different technology things in this market around, like moisture detection in beds, things that one wouldn't necessarily think of, but across the board, obviously numerous cameras in terms of sometimes, it's very like residents can actually go missing in these retirement homes. And so that's not necessarily rocket science, but just standardized things like that. And there are many, there really are many. And it's not that it's not our tech, it's just our mindset and our framework around saying, well, we're going to be introducing all these clever technologies to enhance the life of our residents. But more information, if people want more information, we can certainly provide that. I think it's going to be a key differentiator. No, I mean, I think everybody's going to start introducing it. Like, to be fair, if this is going to enhance our competitors and competitors in the space, everybody wants to optimize the experience for their residents. So I'm sure everybody will, but that's certainly we're going to be implementing it from day one.
I suppose you've got an advantage because you can build it into the whole setup. You don't have to reconfigure.
Yeah, that's what I was saying about, like, sometimes like last move advantage in terms of no legacy systems, etc. It's actually easier to do it. But yeah, I think so. And also, I mean, that's that, this idea of disruption and idea of like, how can one do things better? When one's got an existing facility and things are working well, you're making money and etc. Sometimes it's hard to to change because the model's working. And for us coming in, there's nothing that's working. We want to introduce something upfront from scratch that is going to be differentiated and exciting in this market.
Shark has a good question here. To get ahead with construction, do you need a minimum total investment? And if that amount is not collected, will you pay individual investors back? So if the project doesn't go ahead.
Yeah, I mean, if we're paying individual investors back would be a problem because they potentially would lose the benefit of the 12J. The good news is that we've already got the minimum required investment. So from our initial fundraise, from February, we raised money, and the previous funds, what I mentioned earlier in terms of Lucid Hotel Company, part of Lucid Hotel Company's money that was raised 3 years ago is now being utilized. It's still part of its mandate to invest in hotel type units. So part of that money is being invested. So the good news is we've got our minimum already. We're going ahead. There's no minimum requirement. If we didn't, absolutely, we potentially would refund the money, but that would be a bad result. That it would be the money would just either you would lose the tax benefit or the tax benefit would be recouped, and the investor would lose that. That's really the last opportunity they have now in terms of getting that investment. So rest assured, we've already got enough money to make this viable.
So that is something, if people are shopping around between 12Js, that's a good question to ask because they don't want to lose out on that opportunity.
Yeah, I suppose so. There are many established funds which are, if I spoke about 50, the top 10 or 15, etc., would all certainly have enough money that they don't, they don't need a certain sub minimum, and so that wouldn't. I mean, as long as you're investing in one of the top ones. But I think what I'm going to say around what makes our fund fairly unique in some respects is that the 12J post June, many of the 12J funds will then maybe wind down or completely change their whole business model, right? Because many 12Js, what they did was to say, well, hang on, your tax benefit depends on which marginal tax rate you want when you invest, etc. But approximately 7 to 8% is the tax, the IRR, the return you get, the annual return you'll get just from the tax side. So in other words, if you invested $1 million on day one and you got the tax benefit and you got your $1 million back, so no growth, got your $1 million back after end of 5 years, that would equate, and you paid the capital gains tax at the end of 5 years, that would equate to a 7 to 8%, approximately 8% annual return. Pretty good. 8% is not a bad investment. Now add on to that 5, 6, 7% that many of the 12Js are offering in terms of very low risk models. That's not bad. You're getting, give the guy 14%. That's pretty decent, and particularly if you've managed it and it's low risk. But what happens is from the 1st of July, that the tax benefit disappears now. And now you're not to ask it with that business model. If you approach investors now and say that we're going to give you 6, 7, 8% return, that's not particularly attractive relative to a risk-free rate, or the current risk-free rate. So you're very unlikely to be able to raise additional funding. We believe post this, we're going to be raising additional funding as we want to grow. If we want to raise additional funding with the business model that we have in place and with the growth in this sector, we believe it stands on its own 2 feet without the 12J. With the 12J, even better, then you're just enhancing the return. But we absolutely believe that we'll be able to raise private equity funding post June 2021 because of the reasonable returns that we'll get in this space.
And looking at the questions coming through, there's obviously demand. Victor wants to know, does the life right transfer to the surviving spouse in the event of death?
So that's a great question. So when one buys it with a spouse, a life right spouse, the life right terminates on the death of the last, the second spouse, right? So the last of the couple. It needs both couples have to be within a certain age. I mean, you couldn't. The way a life right model works, if you went to a retirement facility and you're 40 years old, you say, can I come into this facility, they won't set it to you have to be a minimum age, because the model gets broken if the person lives there for 50 years. It just doesn't work. But in a typical environment where both spouses are of similar age, yes, the answer is that the life right endures until the death of the last dying spouse.
And what is that minimum age, Leor?
Different facilities have different ages. You see normally 70 or 75 is quite normal. Once again, that's something we hope to hopefully disrupt that a little bit and bring in a slightly different model where we'll potentially be able to allow, if there's demand and the need for the demand, we'll potentially allow residents to come in at even an earlier age, maybe 65. The way one does that, I mean, it's not that we're missing the boat. Of course, the implications of that, the cash flow implications, if your residents are living for longer. But the way we intend to do it is that there's a depreciation on the life right. So typically, if you bought you buy the life right, let's maybe unpack on the one side for both residents and the other side for investors. How does this business model work? Is we now get this funding and we invest in and we build the facility, and let's say it costs you 100 million rand to build the facility, and then you sell the facility, all the life rights for 100 million rand. So you kind of break even from that day. Everybody owns their life rights. Those residents, there's a separate company, which is your management company, which basically runs the operation, kind of at break even. That isn't necessarily a profit-making entity, but they charge a monthly levy to those residents for just your normal expenses of food and providing care and whatever it is so that's just a normal monthly levy, and that just depends on where they are, whether they're independent living, assisted living, or frail care. Clearly, if they're frail care and they've got a full-time 24/7 person living with them, they pay a substantially higher levy than somebody who's independent. But that's an aside. So let's just go back to the life right side, understand the business model. So you've built a facility for 100 million rand, which is fully funded once you've rolled it out by the life right owners. The way the life right company makes money is then on one side on the growth of the life right. So the life right owner, they invested 1 million rand for that life right. They don't participate in the growth of that life right. So if that life right then gets sold 5 years later for 1.5 million rand, that belongs to the life right company, that growth. They're not participating. In addition, we actually depreciate, in line with the industry, we depreciate the life right. So even though you invested 1 million rand, you won't necessarily get your full 1 million rand back. What's very common in the industry is that they'll pay back 80%. 80% of the investment gets paid back. We would see that being a little bit not necessarily treating all people equally, in that if you live in the facility for 2 years or you live in this facility for 15 years, you're getting a very different benefit to 2 years to 15 years. So our model would be to depreciate that life right over the period that you ended up living in it. So for example, and this is not finalized, but the model would be, for example, we depreciate it by 2% for every year that you stayed in the facility. So if you ended up staying there for 10 years, then 80% of the value of the life right would be paid back to your estate. How one could use that model then to allow younger people is that, for example, if you came in at a younger age, let's say below 70, you could appreciate it slightly, let's say, for example, 3% until you reach age 70, and then 2% thereafter. So a number of different ways to model this. And at the end of the day, you want to try ensure that you get a return for investors. You want to try and ensure that it's marketable and fair to your residents. And we believe that we can create a structure that suits all parties.
Very interesting. And Bruce wants to know, where are the other complexes planned? For example, Cape Town or other areas, and when will they be built?
Okay, so I mentioned we've got 5. If you look at the investment memorandum, there's 5 currently, but they're all in Johannesburg. Certainly Cape Town would be an area. It's definitely on the radar, and particularly the Sea Point type of area looks very underserviced. So that's next on the agenda, if you like. But our current properties, we have one. I mentioned the one in Rosebank. There's one in Houghton. We have the land in Houghton. So Rosebank. There is one in Sandown actually, and then there are 2 on our pipeline that we're looking at purchasing. So existing facilities. One is fully operational. One is partially operational, but like in finalizing of construction. So those are the 5 in the pipeline that we mentioned. And then certainly, we do have hotels. We have 2 hotels in Cape Town that we're operating, so we kind of know that, we know the Cape Town landscape very, very well. That would certainly be our next area targeted.
Would you ever convert those hotels?
Sure, it's a great question. Possibly, yeah. I mean, it's not necessarily the easiest thing to convert once they've already been built, because as I mentioned up front, and when you customize and you build it for custom built, it looks slightly different. But you know, a lot would depend, I suppose, on what happens with hospitality and what happens with the tourism industry. But it is a possibility that one could do that. One could convert a hotel. I hope not, to be fair, because you know, you've spent the money, and for the investors in the other funds, and we've built them specifically for a hotel investment, we hope we can get a return of them operating out of a hotel. But there is always, back to the question about risk mitigation and having a capital underpin. So even though you potentially build a hotel and the hotel isn't operating effectively, you've still got an asset, you've still got bricks and mortar, which you could sell, you could convert, there's a whole host of different things. And once you're out of the 5-year period, you know, there's no restrictions at all. You can operate it as anything. It doesn't have to be operated as a hotel.
Some of your investors might be relieved to hear that there's that option, because there's so much uncertainty around hospitality.
Yeah.
So
I mean,
Jason, oh, sorry, continue.
No, go for it.
Jason wants to know, how much is the fund hoping to raise through the 12J versus total expected costs?
Sure. So the money that's raised to date, so let's say committed capital already, what I was referring to in terms of what we raised in February, plus from the other fund, we had about 90 million. We're targeting to raise, I mean, we'd love to raise between 100 and 200 million in this fundraise. You know, ultimately, it's a little bit of how long's a piece of string, right? There's plenty supply, there's plenty demand, I should say, for this product. We raised 500 million. Would we be able to roll those out and build facilities to the value of 500 million? No problem. What it would mean is we'd probably end up doing less bank funding. Our current, when talking to the banks, they're kind of happy with a 60% loan to value, which means they would fund 60% of the value of a property. So if we were going to build something for 200 million, they would potentially fund 120. If we had a whole lot more capital, I still think we'd use bank funding. I think it's, you know, it gives you leverage, it allows you to, you know, to build more, and it also keeps us honest in terms of them doing the due diligence and making sure they're happy with the facility and the pre-sales, etc., etc. But there isn't really a cap around the projects we do would be dependent on the capital we raise.
And there's a follow-up question to that. What is the anticipated IRR on this project, excluding the 12J tax benefit?
Okay, excluding the tax rate. So I broke it down. So we're talking about a 20% IRR for investors over that 5-year period. That is broken down in terms of about 8% for the tax benefit, and about 12% would be your non-tax benefit. So I would say 12%. I'd like to say, I think we're being realistic, but on the conservative side. There's a lot of, obviously, you know, how long, you know, I'm a financial person and I can play with spreadsheets all day, and I can obviously get something to show any IRR I want, just changing your assumptions. You know, we have a financial worksheet, which are financial considerations, where we say that we're anticipating to get a 20% IRR. These are the assumptions we make, which determine it. And there's obviously many assumptions. The actual model is extremely complicated, obviously actuarially built with, you know, life expectancies, etc. It's complicated, but the number of it is there's probably going to be 5 or 6 key assumptions in terms of what it's going to cost you to build, what do you sell these units at, how long the average person lives for, etc., etc. So if investors are interested, we will certainly share those assumptions with them, so they get a sense of all those reasonable assumptions that will generate that type of IRR.
Thank you. More questions about the opportunity to live there. Philip wants to know, is the life right cost per person or per couple?
It's per couple, right? It's you buy the unit. Obviously, you buy the unit. So it's, yeah, the short answer is per couple. You don't pay per person. Yeah.
Thank you. And Eric asks, what will go into the estate after the life right expires because the resident has died? So will the 2.3 million rand be paid for the life right be lost, or a portion refunded? So perhaps if you could just elaborate a little bit more on that.
Okay, so that's what I was talking to, but I mean, I'm not going to commit exactly, but typically what will happen, and it'll be close to this or exactly this, but our intention would be that we would depreciate, you'd pay 2.3 million rand, we would probably depreciate it by, let's assume that the person moving in is about 75 years old for argument, and it's our standard 2%, and let's say they live for 10 years, and if the person passes away, or the later couple passes away after 10 years, 20%, we would depreciate that 2.3 million rand by 2% times 10 years being 20%, so we'd end up paying 80% of the 2.3 million rand. That's 1.84 million rand that would be then paid to the estate.
So we've got two more questions. One is from Derek, who says that the tax incentives are attractive. What are the downside risks other than the ones you've already mentioned, besides normal business risks? So if you were putting your own money into a 12J, what kinds of questions should you be asking? What would you ask one of your competitors?
Well, the biggest question to ask, which I think I've answered, and which I wish I'd asked myself when I originally invested in the Lucid fund, was how am I going to get my capital back, right? Yes, when you are a minority shareholder in a private company, not listed, where's the liquidity? How do I get the cash back? It's the most important question, and like realistically as a shareholder. And I did ask it back 5-6 years ago when we started Lucid, and you don't anticipate COVID, and you think the market will be different, and you think that there'll be a demand for hotels, and we could sell hotels or get external debt funding, etc. That hasn't transpired, or even if we could, it equates such a large loss. It's not worth it. So I think liquidity, in terms of where does the cash come from, it's having an illiquid asset as an investor, really, really difficult to get your cash back. So I think that's a very important question, fundamental. Other part is obviously how you're managing risk, and what the downsides. Often many of the 12Js, and there's some excellent operators, but investing in high risk ventures, and they'll talk about their track record, and we did fantastic in this investment, we did fantastic in this investment, and that's great. But it does carry a high level of risk, as opposed to when you're investing in property, you have a capital underpin that can reduce the risk. So those would be two key questions, and I suppose costs. I mean, I'm a real passive investor in terms of, I don't like active management. I like passive management typically. So when it comes to listed things, I'm very huge focus on costs and making sure that the costs are managed. I think the cost in our example, that if one looks at the 2% and one says, well, 2%, what it means, I'm paying up to 2% on an annual basis, 2% of my 8% on the tax benefit is given up in terms of costs. I think that's manageable, right? You're still locking in a 6% on the tax side, and then hopefully, when we talk about the 12% IRR over and above the tax benefit, I think the returns are pretty reasonable even after costs. And the returns at that 20% we speak of, just to reiterate, are after costs. It's that IRR after costs that you pay to the fund manager.
Thank you. And then Maria wants to know, can a trust invest into 12J companies? And if so, what does this mean for the life rights?
Well, it doesn't change it for the life. I mean, as an investor into the company, trust would be just like a company can invest in, a trust can invest in as well. It's obviously got a different tax rate. It's also got a 2.5 million rand minimum. I stand corrected if it's 2.5 or 5. I think it's 2.5. But regardless, a trust can invest and get a 12J deduction for their investment. So yes, in terms of the life right, the trust itself, the life right could only be if you. I suppose the question she's asking now is, I've invested via trust, but I want that conversion option. The trust would then have to cede that option as it has to an individual. Clearly, one couldn't. The life right can only be owned by a natural person. It can't be owned by a company. A natural person has to be the life right owner because it's attached to a person's life or people's lives. So it couldn't be the trust that owns the life right, but it could cede that benefit to an individual.
Well, thank you very much, Leor. Jason really enjoyed your presentation and your points, and he says to you, if I'm unmarried, will Lucid partner me with another unmarried resident to share the life rights in a unit?
That's good. That's a possibility, I suppose, right? I mean, I suppose that's in retirement homes, that's often, companionship is a big component. So who knows? That's an interesting model. We can potentially, that's maybe a spin-off business where you could find a way to match up people, and they can buy a life right together. Very clever.
Well, thank you very much, Leor, for joining us today, and to all our attendees for joining this webinar on the 12J investment opportunities. If you want to find out more, please go to the 12J section on the biznews.com website and you can register your interest there, and there are also podcasts and other articles on this 12J opportunity as well as other ones. So thank you very much.
Thank you.
Thank you for joining us for this webinar, which is compiled and produced by the team at biznews.com. A recording of this webinar will be available later today